over 200 points in the green, 230 points to be precise, and it is a 1.2% gain that we're seeing for the Hong Kong market.
Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time.
It has represented a continuing symbolic presence almost since the end of the Second World War.
Tactically, because even the Nasdaq is showing some signs of reversal, my sense is today even IT stocks may play a bit of a catch-up.
So far, in the 5 months of this financial year itself, the industry has done about 20,000 already.
And the Nifty is up about 113 points.
The domestic consumption story in the last few months has been very robust.
Even in the first quarter also, we grew almost about 18%, though on a CAGR basis, we were growing at about 16%.
Continued investment is definitely coming across all business lines.
I don't want to take away the focus of the bank on doing something special, which we are doing, as you probably be observing.
We are very, very excited to launch our first electric vehicle on this milestone day.
The Czech energy or economy minister, I should say, has summoned that emergency summit here today in order to come up with a common solution.
We're still holding up with gains of close to about 1% on the benchmark indices.
Okay, well, good afternoon and welcome to Closing Bell. I'm Anuj with me, Rima and Nigel today. The market, of course, has been strong through the day. It's just that we had a dip during the day today. That's now getting bought. As soon as the Nifty almost slipped in the red, that's where perhaps the algo trades came in, and now the Nifty is up about 58 points. It's the IT stocks which have really helped today, especially Infosys. The bank Nifty as well has been quite okay. I mean, if you look at individual names, within that there are some stocks where we've seen some profit taking, like SBI, Kotak, HDFC, even Reliance. But on the other hand, you have, as I said, Infosys up 2.5, Tech Mahindra doing well, TCS doing well, and a couple of others like ITC also contributing, and the broader market remains as strong as ever. So let's see what the last hour of the week brings for us. Nigel, good afternoon.
Hi, good afternoon. Well, when it comes to IT, at least Infi and TCS, both of them are eligible to do a buyback. Yeah. There's typically a 1-year cool-off between when the first buyback gets over and the next buyback can be announced. So that 1-year cool-off has ended. So both these companies are eligible for a buyback. In fact, for Infi, it ended just yesterday, which is why the street is now so excited. And now all eyes will be on when they declare their numbers on 12th of October, the Q3 numbers. The street is going to be watching out whether there will be that buyback announcement. So IT has clearly been the leadership, has provided leadership today, with the Nifty IT up close to about 2.25%. But let's tell you what we've lined up for you on the show today. Multiplex stocks slide on the back of a lackluster show from September box office releases. A detailed analysis coming up on the show.
Sources tell us that Ujjivan Small Finance Bank is likely to launch a QIP early next week. That's an exclusive. We'll get you more details.
From one exclusive to another, the Competition Commission of India has begun investigation into cartelization allegations by steel players. We'll get you details on that in just a bit.
What's the way forward for the markets and how should one read the volatility? Well, we'll discuss that and more with Rajesh Kothari of Alpha Accurate Advisors.
Well, but as always, we start the show with last hour calls. How should you position yourself for that? Mitesh Thakkar is joining us. Mitesh, hi, good afternoon. So we had a bit of a dip that's getting bought now. Your call on the index and your last hour calls?
Anuj, I think the dip is fine. I think not very strong. I was still watching the Bank Nifty and the Nifty IT. I think you were just highlighting that before once the show started. The Bank Nifty is slightly cooled off, and I'm hoping that the Bank Nifty can still manage to close above 40,300 or levels. That today being the weekly closing, that would be important. And if that happens, then I think we should enjoy good momentum in the next week. But Nifty IT, I think in the short term has clearly taken some kind of it's come into limelight. I think that's where a lot of breakouts are happening. Disclaimer: we have some long position on IT names, so I think that's becoming showing the latest sector to possibly get into an upward kind of a movement in the short-term period. So I think that's where traders can possibly focus upon. Would recommend a buy on Tech Mahindra now. Keep a stop just below levels of around 1100. Look for targets of around 1170 on the upside. Other one which I like is Infosys. Infosys, I would want to see make it a conditional buy, see it get past levels of 1518. Today highs is around that level. That's the gap area. So once it crosses that, buy then with a stop at about 1504 for targets of 1565.
Okay. All right. Mitesh, thanks so much for joining in, giving us that quick take. Well, let's take that IT discussion forward then. Prakash Tiwan is with us. Prakash, I want to ask you about Tech Mahindra. That's the one that had some valuation support. Year to date, that's been a relative underperformer. It's down closer to around 37% or thereabouts. But in this month itself, it's been a relative outperformer because it's up closer to around 5% in comparison to what the IT index has done. And my director will pull up both those two charts. What do you do with the stock at around this 1,100 odd mark?
Good afternoon, Nigel. So, I think while it lost a lot of ground, at the time we saw a big sell-off within IT and an entire reset on the valuations. In fact, it lost about 52%, if I remember correctly. And then it's kind of recovered for the simple reason that, the average PE multiple, the median PE multiple for, let's say, the last 5 years at which it has traded, it's now kind of close to that, if not lower, which means that at least you're not kind of overpaying from a historic perspective in terms of what the company always has attracted as premium valuations or valuations thereof. And interestingly, the rollout on the 5G has probably been much sooner than anticipated, Nigel. So my sense is that their expertise, their lower dependence on verticals that are probably languishing or experiencing more slowdown is helping them. The product mix is far more superior. And remember, that's the only company in the last 6 months that has actually been on a hiring spree in terms of freshers. And the bench strength is fairly strong as compared to some of the other ones which had to probably pay much higher wages to kind of make sure that they were manned correctly or adequately. So that's kind of working or started to work for them. The question is whether you buy it at this level. My sense is if you have a long-term view of 3 years plus kind of this thing, you definitely could, because even with the volatility, you'll probably even out in terms of your gains, and it will give you market superior gains from here on, even at this 1100 plus zone. But yes, of course, you had far better opportunities, but at that point in time, the sector itself was probably not very attractive. So, that's where the reaction is.
So over 3 years, you're saying the sector looks attractive, Prakash. But what about over the near term? Say, FY23, the next couple of quarters. If the world slows down, as is being predictive, things can get challenging for IT. And we already have signs that deal wins have come down on a quarter-on-quarter basis. So if you have a 1 year time horizon, what's the advice?
Good afternoon, Rima. I didn't know you were on the panel as well. Having an IT special expert is always a challenge, talking specifically about the near term, because yes, there are likely to be far more wage pressures, far more cost increases as compared to what we've seen, on a YOY basis. If you see, with travel coming back, and a lot of the clients would probably, this whole offshoring, onshoring mix also is kind of, I'm seeing going through a significant change, which keeps on increasing costs for some of these companies. But then you'll have to start being selective. I mean, you'll have to look at companies which have an expertise on certain areas which are critical enough for clients not to kind of discontinue or slow down spends on. And that's precisely the hope. But the US and Europe economies are very clearly giving you that sign that there could probably be some sort of a tough time, but it might not be a hard landing for IT businesses as a whole because of the continuity. So anybody who is into verticals related to travel, related to oil and gas, will probably continue to see some benefits, but maybe BFSI takes a little bit of a backseat, maybe healthcare takes a backseat. So you'll have to start sifting through on those angles. From that perspective, question is, what do you look at buying? If you look at some of the smaller companies within Indian IT itself in the near term, there could be some sort of a comeback of sorts, So that's what I'm anticipating. But it's always the first large ones that will probably participate. So you've seen Infi, and Anuj and I spoke about it a couple of days back, given the fact that there was this buyback effective date of sorts that kind of makes it possible, or a possibility potentially. So those things will come in the way, but you buy IT on dips and be in an accumulation mode, Rima. That's the whole idea. You don't kind of start harvesting so soon. There's nothing to harvest. But this year is going to be a time to accumulate longer term stocks, if you like, that sector, and then of course ride through the slowdown or the volatility that will get manifested because of this slowdown that's anticipated in pockets.
Okay, well, Prakash, I want your thoughts on PVR and Inox, but let's first address these via a simple analysis. Now, the stocks are under pressure on the back of what's likely to be another poor showing, which is Brahmastra. Though, of course, advances have been good, but the reviews have been quite poor. Here's Vahishta with all the details. Vahishta?
Well, thanks for that. Well, multiplex stocks have actually had a weak show today on the poor content of Brahmastra. Now, remember, this movie is a big hope for the film exhibition business as a whole, and this is because the initial 2 months of the ongoing quarter, Q2, have not had a very good performance. So, movies like Liger, Lal Singh Chadda, Shabash Mittu have actually not performed very well. In July, the total box office collections were weak at 270 crores, while August was even weaker at 142 crores. Now, with the weak reviews that we've received on Brahmastra on the very first day of its release, this could possibly mean that September may not bring in much cheer for the film exhibition business as a whole. And it could also mean that H2 of the ongoing financial year has had a weak start. Now, Elara Capital had expected the box office collections for FY23 to grow 4% versus the pre-COVID level. This despite factoring in a Q2 weak show. Now remember, Brahmastra's advance bookings actually were very strong. So a big reversal in PVR and Inox performance is likely only once the box office collection scripts a turnaround in the months to come. In terms of some big movie lineups that we have for September, we primarily have The Woman King and Vikram Vedha. But Vikram Vedha is expected to be released on 30th of September, and hence the collections would flow in the month of October, which is in Q3. Now let's see what the brokerages have to say about the multiplex stocks. For PVR, the average target price is at 2,300 rupees, while Inox is at 650 rupees. In terms of valuations, PVR is at FY23 P multiple of 60 times and Inox is at approximately 30 times. Now the only trigger that could mean for the multiplex stocks is the NCLT approval for Inox and PVR.
The merger, that is. Vahishta, thanks a lot for that. Now, Prakash, if you go by Hindu mythology, Brahmastra literally is the last weapon, right? I mean, when nothing else works, that's what you use. And once you take it out, you can't put it back, right? So, if that also fails, I mean, we're not saying it does, but chances are it may. Then what really is the future for all these companies? Of course, both PVR and Inox.
Yeah, good afternoon, Anuj. So, yes, Brahmastra is the supreme weapon or whatever, in your armory. But, this is a very clear clarion call for the industry as a whole to realize that things have changed dramatically. I mean, the shift to OTT is not just pandemic related. The shift to OTT is not a fad. OTT is here to stay and probably grow at a faster clip than what conventional exhibition of films would entail. Remember, the spends that you have when you go out to a PVR or an Inox are far more superior, and all of us know about it. And the propensity to spend discretionarily on these things will eventually start finding itself, will pave the way for more attractive spends or more time consumption on OTT platforms. I mean, it's far more custom-made. It's far more easy to kind of slice it in terms of your time availability, time of the day, so many things. So my sense is, this whole sector will get redated. I mean, 65 times multiples for a PVR kind of a business because it had the lion's share in the industry is fine. But if the industry itself is shrinking, you'll probably do a reset in terms of G multiples, and that's where it will happen. But all of that will probably is not really coming into picture in a very dramatic way, Anuj, right now because of this, overhang of the merger. Because once the merger gets, the combined entity happens, people probably believe that they'll be able to drive things in a very different way. I don't know how that will happen because there would be price restrictions coming in if they were to do anything related to that. So you'll have to see in terms of efficiencies, probably if they can increase something, reduce overlaps and things like that. But at this point in time, it doesn't look like an industry to put your hand into till it consolidates and stabilizes at lower valuations.
So PVR and Inox is an avoid till we get clarity on the kind of synergies, the benefits the merger will play out, considering the OTT competition?
Yes. That's precisely what I was telling you, that you just stay away from this till that happens. And even after the merger, in terms of what all gets rolled out, that's when you probably start looking at buying into it. And then you don't have to be confused with which one to buy. You just buy one entity, the combined one. So that makes it easier.
Well, let's pull out intraday charts now for Ambuja and ACC. Remember, the open offer ends today. Now, conventional wisdom is if the price of the share is much higher than the open offer price, why would anyone tender? And then what happens after the open offer is over? Nigel, tell us.
Well, Anuj, actually the stocks have come off the entire cement pack because there are some reports which are not confirmed by us that there is a CCI inquiry that's going on. So the entire cement pack has come off. The problem is that financially it doesn't have a big impact. The point is going ahead, the price increases become difficult every time there's a CCI report out there. For ACC and Ambuja Cements, well, as Anuj said, when the price of the stock is higher, than that open offer price, obviously you're not expecting very, very great response out there. And I think that's precisely what's happened. For ACC, until yesterday, there was close to around 23-24 lakh shares that were tendered. And for Ambuja, there's only around 5 lakh shares that were tendered in. It started on August 26th. It ended on, September 9th. And, ACC now is trading well above the 2300 odd mark. Ambuja Cements, with the word go, from the day it started only, it was much over that. So let's see what happens from here on. But clearly, it seems someone is really backing these stocks after they've been not been the preferred picks actually from the cement space in the last 10 years or so. Prakash, what's your take? Dalmia is your favorite, but among ACC and Ambuja, what's your view on both these two? The street clearly is believing the new promoter is going to be very, very aggressive, going to improve profitability, going to expand organically and inorganically. Valuation-wise, now it's headed towards Shree Cement, Ambuja Cements, that is. What's your take?
Yeah, so you're right. Ambuja is much richer in terms of valuation. So there's much more headroom to reduce that. As I mentioned some time back, $160 per ton versus an ACC at 122 or something. So there's enough of arbitrage, and that Ambuja thing is very clearly the area where you will probably see very dramatic improvement as we go along. It's not easy for the company as a whole to do it, but the new promoters have a reputation which you could rely on in terms of their ability to bring efficiencies up. And the second thing is that acquisitions post this merger, post this acquisition, you'll probably see a string of acquisition that might make sense only to fill gaps from a geographical or some sort of a advantage on logistics perspective. So it's not just capacity that they would be looking at, but there could be limestone availability, there could be logistics and distribution strength. So those things will start playing out much more after that. So it's not, I'm not expecting that to happen too soon, Nigel, but at this point in time, open offer aside, Ambuja at 460 whereabouts is still definitely a lot of value. So people who have it would probably continue holding it for some better price realization going forward.
In fact, names like Shree Cement have had a fantastic week with a rally of close to about 17.5% for Shree Cement this week. Prakash, any thoughts on Nazara Technologies? For the last 3 days, it's seen very large volumes, and today there is price action as well. The stock is gained close to about 13%.
So, I think I'm not too sure how strongly it could get correlated, but the major change that's happened in the industry, which I would kind of want to use to connect the dots, is remember that Google is started kind of putting out some of these new gaming platforms, apps on its Play Store, and if that genre of gaming were to kind of and if Google puts its weight behind this thing, you are sure that you'll see these pop-up ads everywhere. You'll probably start looking at people utilizing that to some extent, much more than what dominantly today is. So you'll probably expand the market in a significant way, and that's always good news for the market leader domestically, right? So I think from that perspective, it seems like there's a little bit of a rethink on that sector, and there could be a flip, and then that's what people are banking on. And Nazara was available at much lower valuation than historically what it has been traded at. So that's probably the comfort, and the market always wants a new idea. When you're closer to your all-time highs on most stocks that you own or you didn't get to buy, the FOMO will compel you to buy into things which probably still have some upside. So that's what probably is happening. But I don't know in terms of any other fundamental change that could have accrued in the last few days to justify this, except for the one that I explained.
Okay, let's do one thing. Let's take a break. The market, just look at a couple of stocks, by the way. Astral, even though in the last few minutes of trade it's come off, intraday still it's seen a fresh, big rally, and for last 3 or 4 days it's seen a rally. Of course, in the last few minutes it's seen a bit of a knock, but IT is doing well. L&T Tech Services, L&T Infotech, Persistent, all these stocks. Mindtree right now at highest point of the day. Infosys as well. We'll take a break. Up next, we'll connect with Rajesh Kothari of Alpha Credit Advisors on his big calls on the market.
Well, it's IT all the way. IT is still gaining as we speak, moving higher. You know, from the start of the show, stocks like Tech Mahindra, Infosys, TCS, all of them, they were just gaining and they moved a little bit higher. So that's where we move back towards the high point of the day, moving towards the 17,900 odd mark. And Maruti out of nowhere, well, that stock as well has seen a bit of a bounce back along with Tata Motors. Let's move on then. Sources tell CNBC-TV18 that Ujjivan Small Finance Bank is likely to launch a QIP as early as next week. Abhishek Kothari, he's on top of that. He's joining in with all of those exclusive details. Abhishek?
Well, as you mentioned, Ujjivan Small Finance Bank is going to launch a QIP next week. That is what sources is telling CNBC TV18. So they may look to raise around 400 to 500 crore via this QIP. The QIP is likely to have a minimum base offer of 20 crore equity shares. So capital raise would strengthen the balance sheet of the bank. And there have been 2 domestic, bankers which have been appointed for this issue. So demand is pretty healthy for the issue. Book has already now seen 125% of the demand that they were ready to offer. A calculation shows that, if you take into account a 500 crore capital raise, the net worth will strengthen by 16.6%. Book value will increase by more than 3% to close to about 18 per share. Equity dilution will be around more than 13%, that is about 13.2%. And Tier 1 ratio, now that will strengthen by almost 386 basis points of what they reported in Q1 FY23 to now about 22.6% post the equity raise. We have written to the bank and we are still awaiting their response. Back to you.
Thanks a lot for that, Abhishek. Prakash, what do you make of this one? They're going to be raising some money. It's going to improve their ratios. Your take on it?
Yeah, so I think this was something that this organization needed. Of course, that goes for a lot of these SMEs where capital raise will continuously be something that they will have to engage in over the next few years, given the expansion that they are seeing. What's interesting is that small finance banks were supposed to actually be very comfortable with the deposit inflow, and hence could kind of do things much better, but that's not happened. So for some reason they end up having this mismatches on the debt equity side, and hence equity keeps on getting required to be bolstered. So it's a bit of a complex business. I don't particularly like it for the simple reason that it's been very lumpy in terms of returns as well, and you have these long spells where the returns probably are sub-market of sorts. But look at things like housing finance, look at things like SME finance. Those are the areas that probably will grow, and there are enough NBFCs and small banks in the private sector that you could choose from. So at this point, I'll definitely let the institutions take up that appetite that Abhishek spoke about that they have for Ujjivan. I would look at some other things than this at this point.
Prakash, do stay on. There's another story that we'd like your thoughts in, but before that, let's listen into it. The CCI has begun investigation into allegations of cartelization by steel companies. Tim C is joining in with more details. Tim C?
Well, that's right. What sources are telling us is that the Competition Commission of India has started investigations into allegations of cartelization by steel companies. The companies that are under CCI scanner include Tata Steel, JSW, SAIL, Vizag Steel, Tirumula TMT, Kamachi TMT, and many others. And also important here that CCI has started investigations based on a plea filed in the Madras High Court. The plea was filed by Coimbatore Cooperation Contracts Welfare Association, who had approached Madras High Court seeking a CBI probe, and then CBI forwarded the complaint to DG Investigation CCI for a detailed investigation, since these are matters of cartelization and CBI wanted CCI, which is the appropriate body, to look into the allegations. Remember, association had alleged that steel companies have acted as a cartel and hiked prices together. Comments are awaited, meanwhile, CNBC-TV18, since it has reached out to Tata Steel and JSW. But let's see what happens finally once the investigations begin. Back to you.
Okay, Prakash, what's your view on steel stocks?
So I don't think the government is going to like any kind of a indication if there has been this some evidence to this allegation, because the whole idea of putting those restrictions on exports and all was to make sure that steel prices don't inhibit any sort of a growth on the spends here domestically on infra and other things. So I think this could probably be a little bit of a negative impact, and there were these expectations that exports would be allowed and things would come back to normal much sooner, and that doesn't seem like happening either. Now globally the setup seems to be very clearly defined by energy shortages, so you'll probably see a lot of the non-ferrous side where demand contraction, supply contraction will be much more sharper. Ferrous is still China led, and I don't see that to be an issue as yet. So it's going to be volatile, but the ability of steel companies in India to increase prices and enjoy what they did for the last 18 months is probably not happening too soon. So you'll probably go through a state of consolidation before the expansion happens. The moment some trigger globally gets positive, whether it's a Ukraine-Russia war or whether it's some sort of a revival on the energy crisis in Europe, then things would be very different. But till then, you'll probably see them sideways and probably with some pressure given this overhang of what investigation is being talked about.
Prakash, thank you very much for joining us this Friday afternoon. Have a lovely weekend. Let's also invite Rajesh Kothari, the Managing Director at Alf Accurate Advisors, on the show now. Rajesh, afternoon, and thanks for joining in. For the last few days or weeks, the narrative has been India's outperformance, its resilience, the fact that it's possibly decoupled from the rest of the markets with the kind of outperformance we've clocked in. But the truth is that even if the markets can decouple over the short term, economically, we're still very much linked to the rest of the world, and those linkages cannot be broken. So considering all that, the turmoil that we're seeing, particularly in Europe with rising energy costs, the Fed is likely to continue to hike very aggressively, and therefore there is a possibility of a slowdown. Keeping all that in mind, do you think India can continue to, be decoupled from the rest of the global markets? What are the risks that you see now?
Well, I think, focusing at times too much on macros will lead to, the losing opportunities across companies and sectors where there are clearly India is coming out as a winner, on the global scale. If you think through it, if you look at the global markets, India was major exporter in IT, clearly number one. Second was pharmaceutical. India is considered as a medical store for the world. And third was textile. Over next 10 years, probably we are going to add another 3 categories. One is specialty chemical, second is electronics, and third, to some extent, maybe even capital goods. So I think India is changing, and when we look at too much on macro, the fear of recession, fear of increase in interest rates, fear of inflation, every country has its own, what I would say, equations, correct? And if you look at last 10 years, India inflation was 6%, our current inflation is 7.2%. Compare that with US, last 10 years inflation was 0.5%, and current inflation is 9%. Clearly two different economies, am I right? And same is true even for Europe. So I think, I'm not trying to say that India will be completely decoupling from the world, but at the same time, I would say that don't focus too much on macros on the world right now. If India as a country, if we do well, then surely equity market will do better than other markets. If other markets, probably after 6 months, US also inflation concerns will come down. And then US will also start behaving differently compared to what we are seeing in just last 6 months or so.
Okay, fair enough. Rajesh, hi, good afternoon. So, what's the kind of stocks that you are positive on? Anything that you've added recently since our last interaction, Rajesh?
Yeah, so basically, we keep, identifying companies in 3 favorite sectors which we like the most. One is specialty chemical, second is capital goods, and third is auto and auto ancillary. Apart from, of course, two major sectors which we own in our portfolio, that is banking and finance and consumer discretionary. So we keep identifying companies in this space. Like last time also we discussed at length about few of the companies which we continue to own. We continue to add those names, companies in fluorine, for example, SRF and Naveen and companies like that. One more company which we added some time back in our AAA mid-cap and small-cap PMS plan is a company called Epcotex. It's very good management, almost debt-free balance sheet, 18% ROE. The company's market leader, probably number one in the country in latex. And we believe that company's position for the significant growth opportunity over next 3 years or so. So this company is roughly, I think, about 100 crore profit-making company currently. And we believe this probably company can double its profit over next 3 years or so. So yes, we are basically doing bottom up. When we talk about these sectors, on these sectors, we are positive from the top-down perspective, and objective is to keep identifying companies which are clearly market leaders with the best of the balance sheet and best of the governance, and very importantly, strong earnings growth compared to normal GDP nominal growth of 10-12%. So most of the portfolio companies grows by 18-20%.
This Epcotex, Rajesh, it's done well over last 1 month, but and if 100 crores is the kind of profit you're expecting this year?
No, it will probably profit will double over next 3 years. So maybe we think that profit can be as high as 200 crores over next 2-3 years.
So then, relatively looks quite cheap, right? I mean, any sort of red flags here?
No, company has already made a profit of 100 crores last year. So from 100 crores to 200 crores is going to be journey over next 2 to 3 years. It's a best managed company with almost like a debt-free balance sheet, as I'm talking about, and very niche player. Whether it is a cheap or expensive depends, how one looks at it. But as you are aware that we are a growth-focused portfolio with a very strong underlying business mode. Company's market leader, number one, with the zero debt balance sheet, with 18% ROE, and with, of course, strong earnings growth. If you put these 4 parameters in our investment framework, that's how it fits into our investment thesis. And with the entry into the latex gloves market, where probably the world leader, there's a company called Synthamor, is the world leader. The company's capacity is now coming on stream. And as that happens, the market size opportunity will be pretty large. It will be close to about, I think, 5,000 to 7,000 crore is the size of opportunity which they can cater to for the world market. And that can be a big growth driver for the company, in our view, over next 3 to 4 years.
All right, got that. What about from the consumer discretionary end of things, Rajesh? What do you like from there? If you can name a couple of stocks.
In consumer discretionary, there are a few companies which we already own and we continue to add them. One is, of course, Trent. Generally people think that Trent is very expensive stock. People talk about 75 and 85 PE. But what we look at Trent is a little bit different. So if you look at Trent, everybody knows Trent buys Westside. Westside is the biggest, most famous thing, am I right? In FY18, Westside, I think, was having 1.6 million square feet under its bag. And come to FY22, you have a Zudio, which is 1.6 million square feet. So Zudio is almost equivalent to size of Westside, which it was 4 years back. So it means if you want one Trend, actually you got now size of Trend kind of thing, because Zudio is now equivalent to Westside 4 years back. And next 3-4 years, Zudio probably will continue to add another 1 million square feet. And of course, Westside will also grow organically. So that's kind of a growth I'm looking for. So I think this kind of a company will continue to grow at about 20-25% compounded over next 4-5 years. Clearly, the roadway is a huge opportunity from unorganized to organized. And they are very, very efficient retail player. So this is one company which we continue to like across our portfolio. And of course, there are many more selective consumer discretionary name which we keep adding, like for example, Safari. We continue to own Safari. There are only 2 companies in luggage. We really love oligopolies. One is VIP, second is Safari. We own Safari from quite some time, and we continue to like that name. So that's kind of a characteristics what we continue to enjoy in consumer discretionary.
Okay, Safari, Trend are some of the stocks that you like. Rajesh, just wanted to get your thoughts in on the MF data which came out earlier today. Equity inflows have come in at a 10-month low at just shy of that 8,000 mark. If you strip out the SIP figure, which continues to be steady at 12,500 crore, we are looking at discretionary spend, those one-time lump sum inflows which come into the equity markets being negative for the second consecutive month. What is happening from the retail front?
Well, I think probably retail is also becoming smart, and probably they are buying more at the lows, and as market goes up, they are a little bit staggering their investments, which is a smart thing to do from the retail perspective. But overall, if you look at in last 12 months, I'm sure everybody talks about it, the kind of money what FIs have sold in India and kind of money what domestic have invested in India, I mean, it's huge. And I think financial inclusion in the equity as a percentage of the total savings is going to go up, and we keep meeting a lot of investors, HNI, mid, small, all size. And one trend is very clear. Everybody understood that equity as an asset class, one should keep adding to, and any decline, they're going to take as an opportunity. That's what at least feelings what we get from them.
Rajesh, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always. That's Rajesh Kothari from Alpha-Accurate. Epcotex is the stock that they've recently added, and that's perhaps they call. In terms of markets, it's doing quite okay. GSPL is now the top F&O gainer, up 6%. We'll take a break. Up next, as always, we'll get you a check from the dealing rooms with Mitesh on D Street Chatter. Nimesh, and Mitesh Thakkar will be joining us for our technical calls as well. Welcome back. The market is, incrementally not doing anything. It's just been there, 50 points higher on the Nifty. The Bank Nifty, which had sort of underperformed for a bit, is now beginning to make a move once again on the higher side. So that's something to track. 245 higher on that one. Nimesh is joining in for D Street Chatter. Nimesh, tell us what have you picked up today?
Hi, Ranjana. Today is a day of bit of profit booking, and that's the overall feedback from the dealing rooms. And even in the flows, it's very evident that there is a bit of profit booking from the larger institutions as well. Largely in the financial names, which have rallied pretty hard, and some bit of profit booking in the cement stocks as well. Remember, cement was a big sector entire this week, and now you're seeing some bit of profit booking in those names. On the other side, there is a bit of sector rotation continuing. So a bit of buying is back in the technology names, and to some extent, the buying in the auto names continue. So that's the overall feedback. In terms of technical levels, both Nifty and Bank Nifty are above the crucial breakout level. So that way, that's something which is positive. But on the downside, now the support on the Nifty Bank would be around 40,000 levels. But from a flow point of view and from the overall feedback, today is a day of profit booking. Maybe it's just a one day phenomenon because of the weekend, but there is a sense of money to getting out of the table to some extent in some select names like banks and the cement stocks in today's trade.
Right. Nimesh, what about stock-specific action? What are you picking up?
So in terms of individual names, Nigel, the first stock is RBL Bank. Within the small private banks, this is one stock which has relatively outperformed today, purely on back of buy flows at an HNI. So looks like the HNI interest is back in RBL Bank after a few days of consolidation. So that's the first one. The second stock is Syngene. Post the Biocon block, that stock has been consolidating around these levels. But in terms of feedback, there is a clear feedback of some bit of buying interest back from larger institutions in Syngene after the block deal got over. So that's the second one. The third stock is IndusInd Bank. Now within the financial names, while there is some bit of profit booking in select band stocks, IndusInd Bank stands out in terms of buy flows at a leading FI desk. Plus there was a Credit Suisse note as well, where they spoke to the management, and the management is quite confident about credit growth. So bit of interest is back in IndusInd Bank from larger FIs. And the last stock is All Cargo Logistics. Mid-cap stock buzzing in trade today, up 7% last when I checked. And again, there is a bit of buying this back from larger HNIs in this particular stock, and hence a big move in that stock as well today.
Okay, Nimesh, thank you very much. This is our Friday favorite indeed. But let's also invite Mitesh Thakkar once again back on the show, and he's going to tell us what you can buy today or sell tomorrow for a reverse trade on Monday. Mitesh, over to you.
So Birla Soft is something, again, that's another IT name, which is on the list. Birla Soft is something which is breaking out nicely. So BTST with the stop at 326. Look for targets of 335 to begin with. And the other one which I like is Aisha, that's making a fresh high and could possibly see some continuation tomorrow. So that's a BTST with the stop at 34.54 for targets of 35.10.
Okay, that's some calls. Well, just keep an eye, by the way, on Piramal Enterprises. That's a stock which, we recently had a guest as well talking about the special situation stocks. Piramal, of course, recently started to trade X of that pharma business. The pharma business list in maybe another 2 months or so. Now, X of pharma, the fair value which was being ascribed to the NBFC business was somewhere around 1200. I mean, 1100 to 1300. But the stock after listing has been just showing one-way downtake, but it's taking some support at 1000. Because a lot of people are not interested in the NBFC business. They were in Piramal basically for the pharma business. And now that the pharma business is going to list separately, those who have the residual shares are selling out of this business, Piramal Enterprises. So is that selling coming to an end, some kind of exhaustion? Maybe. There's no way of knowing when exactly that happens. But, it keeps bouncing back every time it goes to 1000. And then every time it goes to 1020, 1025, it falls as well. So let's see how that one moves. Anand Tandon is joining us now on this leg of the show. Anand, hi, good afternoon. Thanks for joining us. One of the stocks of the day today is Infosys, Anand. The street betting on perhaps a buyback now that the cool-off period is over. But your thoughts on the stock?
Well, the sector itself has been under some pressure because of the assumption that, the margins will remain under pressure, and more importantly, the international markets will kind of pressure the sales as well. But, if you look at the rest of the stocks in the market, I don't see why you should be selling out at these levels. Yes, there is no doubt that they are expensive, and so is Infosys compared to its own historical numbers. And given the fact that this year the growth rate is likely to be muted, and therefore you're likely to get mid single digit kind of growth for the bottom line, doesn't make it very attractive. But at the same time, the rest of the market is also grossly overpriced. So while you may get some bit of upside because of this buyback, the fundamental question you have to answer whether you want to be in the sector. I think you should be marginally, you should be there at least, market rate, if maybe marginally underweight, but not much more. See which other companies are going to hold. You will finally come back to companies like TCS, Infosys, maybe HCL Tech, and so on. So from a portfolio perspective, I don't think that there is too much of a debate. From a standalone stock trader's perspective, maybe this is a sector which is going to be weak for some more time.
Okay, but if you are a long-term investor, then perhaps there is nothing to worry. Anand, afternoon. What about Bajaj Auto? Bajaj Auto will go home as the biggest loser for the week, with a cut of close to about 4.5%. Yesterday, CLSA came out with a note where they raised concerns about the export business for Bajaj Auto, which prompted them to lower the target price. Your thoughts on Bajaj Auto?
Well, as the analysts said, there is the main attraction for Bajaj has been the fact that they have an export market. If you look at what they've been doing in the domestic market, many of their launches in the more premium segments have not been particularly a runway success. And at the lower end of the market, they have been losing market share. They got out of scooters. That was almost looks like a strategic mistake. The motorcycles, the lower end has not collapsed like they have been predicting. So they have been losing consistent market share. The upside was that they have an international presence, and therefore they will be able to continue to grow on a global scale. If that were to be taken away or were to slow down, obviously you'll have to put a cap on where the valuations can go. The domestic market seems to be now somewhat saturated as far as two-wheelers are concerned. The growth rate overall for the industry has also slowed down. Even now we are looking at roughly 60% of what we were a couple of years back. So the outlook for the sector looks a little bleak at this stage.
Okay, the outlook for Bajaj Auto, particularly the export portion, looks a tad bit bleaker. What about Shree Cement? That's been the big mover this week, up 17.5%. Your thoughts on Shree Cement and the entire pack?
So, Shree Cement is the most expensive probably in the whole sector. So I don't know how to comment on that. But the sector itself, will remain in play it's a strange sector because it doesn't really form a very large part of the index or the economy, and yet it remains in the news for all the wrong reasons, which is that there are spurts at which it tends to move up, and then after that there is a long period over which it goes to sleep. The assumption that because of the fact that we have huge strong cartelization, the fact that you will continue to make serious revenue growth is undercut by the expansion that continues to happen. And I think at this stage there is a new, the Adani takeover has also added a little bit more uncertainty in the sector. So it's not a sector that I think you will likely make huge money on unless you try and look for something which can be a potential takeover candidate in a further consolidation for the sector. Otherwise, it is better that you, if from a portfolio perspective, stick with the largest like Ultra Tech, or if you want to take a bet on those which are growing the most, then maybe Bharat is something that you could be looking at.
Yes. In fact, we've spoken about Shree Cement, I think on the day when the Nifty changes were announced, that perhaps Shree Cement has bottomed out. That's traditionally been the case. Stocks which move out of the Nifty, they move out because they have underperformed, right? So, and in general, the pressure of, index funds selling also goes away. So, maybe, it had fallen about what, 35% from its highs, Nigel? Yeah. So, maybe it had become a bit attractive as well, and with the sector tailwind helping it, and the fact that it was out of the index, and that was the most expected change which finally materialized. All of that combined to sort of lead to this kind of move that you've seen.
Anu, just one more point on Shree Cement. It's been valuation-wise the most expensive stock, on EV upon EBITDA or EV per ton. Now, suddenly they're talking about inorganic growth, possibly inorganic growth. If they buy an asset, they'll buy it at only $100. And they could buy it at around 10 times EV upon EBITDA at most, if you buy a 10 million ton plant on. So that could, play out in the favor of the valuations, because the blended valuation will come down on an EV upon EBITDA as well as on an EV per ton basis. Mr. Bangur has said numerous times that we're doing organic, but we could be looking at inorganic. But now the street believes that maybe they'll be a little bit more aggressive. Otherwise, Shree, for the last many years, they put in their bid. If it doesn't come at their bid, they have no problems. They go on with their organic growth. But now with the new player come in there, suddenly these guys as well have to be a little bit more aggressive. Normally, there was only Ultratech out there that was the big boy in there. So it'll be interesting to see. The blended valuation could come down if they do an inorganic growth. I think the street is sniffing something on those lines.
Oh, absolutely. And that could be another factor. And, in case you want to know why Shree Cement trades at so much premium over its peers, maybe you could check out my off the charts that I had done about 2 years back. I had explained why that's the case. A bit of a plug here. Okay, we'll do one thing. We'll take a break. We'll come back, and of course market close, and we'll have a couple of more stock calls with Anand on the other side of this break.
Welcome back. We're counting down to a week where the markets have seen a gain of close to about 1.7% on the benchmark indices. The mid-caps have outperformed this week with a rally of more than 2% as we speak. And we've just got about 8 minutes of trade left. And with the weekly gain that we're likely to end with, we've also snapped a 2-week losing streak. This week, autos took a bit of a breather, but cement did well, and IT, especially on the last day today, the Nifty IT index is up more than 2%. IT is providing that bit of a strength. But let's get you some market opinion. Earlier today, we caught up with Mihir Bora, Director and Chief Investment Officer at Max Life Insurance, to understand his sectoral views, and he seems positive on cement. Listen in.
Cement is always a sector which, surprises on the upside whenever people start talking negative about it. And that's because ultimately there is a bit of, there's a lot of supply discipline in the sector, which they have demonstrated over a long period of time. And it's one of the very pure local segments, I would say, purely local sectors with supply discipline. So that's how, whenever there's a bit of positivity on the local economy, the domestic economy, cement does tend to do well. But it's also supported by some good anecdotal data points. We have seen that real estate has been doing very well, especially on the urban demand side. I don't think it's crowded yet because the banks have moved up, of course, in the last couple of years, but they are still not outperforming vis-a-vis the pre-pandemic levels. So I think banks underperformed quite a lot from 2020 to 2021, and I think it's only catching up. And if you compare the valuations of the sector, both private as well as public sector banks, they are not really crossing the previous highs. So there is some valuation support there. There is a good chance of demand continue to do well, but not as well as we've seen in the last couple of years. I'm talking about corporate demand for IT services. So all the pent-up, spending that companies had to do, or extra spending that companies had to do to enable high volumes of streaming traffic, high volumes of online shopping, high volumes of work from home requirements for connectivity, etc. So all that spending, which was forced due to the pandemic, has been done in the last couple of years. So maybe the robustness of demand will continue, but not to that extent. And valuations having moved up by almost double 2 to 3 times in the last 20 to 30 months makes a case for some amount of consolidation of IT. So I think it's a global sector, and the markets are playing the local sentiment as of now. The bigger driver is China, because in the global scheme of things, Europe, whether it's aluminum or steel, does not really matter much as far as the shutdown in capacity is concerned. So what we need to focus is on China. And there actually they have been, while of course as we discussed, there is a slowdown, but they are also managing the supply side quite effectively. So they may not let the prices crash beyond below a certain level, and since they have the largest capacities in any case, I think you may not see the kind of lows that you saw, say, pre-pandemic or during the pandemic, etc. So I think it's kind of a neutral kind of situation as far as the supply demand is concerned.
All right, let's get a final couple of views before we wind down. Then, Anand, I wanted to ask you about Astral. For this week itself, it's had a great week. It's up close to 12%. It's valuation-wise not very, very cheap. But suddenly that one's moving higher. Any view on that one?
Well, like you said, it's not very cheap. It is based on a sector where there has been reasonable demand in the near term. And consequently, you could understand why, if you're chasing growth, you would look for a sector like this. But I would imagine that, you are, with interest rates rising, I think some of that, some of the growth that you're likely to see from, housing and related activities may also come under some bit of pressure. So I don't know whether it's the best time to be getting into a stock like that.
Mitesh, any last minute trades that you would recommend? Anything that stands out?
On the Nifty, I think, we've seen the index come up a bit. So I think either you can go long in IT and, sell Nifty, take that as a pair trade, or maybe just cut down your Nifty exposure, because the index is not doing very, it's not performing as strong as the other indices like your Bank Nifty and the Nifty IT. So I think maybe the Nifty, I would want to drop some positions, go slightly lighter over there, but be more aggressive on the IT side.
Okay, all right. Well, thanks so much, Anand, as well as Mitesh, for stopping by, giving us your view on a whole host of stocks. Wishing both of you a good Friday evening and a rocking weekend ahead. Well, let's wind down then on the markets. It was that sort of a wobbly day. We came up the high point of the day. We had a good week. The last few days, you turned up and, in fact, you made some money. Today, it was not all that great, because we came off the high point of the day. We drifted around 17,800. Then you thought we were going to be closing closer around the 17,900 odd mark. That didn't happen. IT had a field day. That was the index that really did a big outperformance. Mid-cap as well as large-cap IT names, they did very, very well. Why did the market struggle today? Well, cement stocks came in for some profit taking. So we had Ultratech Cement as well as the ACC and Ambuja Twins. Both of them did see some selling. From the large cap names, SBI Life and HDFC Life, both of them pulled back a little bit. And larger names on the index like L&T as well as HDFC, both of them drifted into the red, particularly in the final hour of trade. And both of them end in the red. Well, that's telling you a large part of the index is trading in the red. And that's why we couldn't really move to around the 17,900 mark. Reliance Industries as well was down close to around 0.5%. On the flip side, the IT names that I was talking about, Tech Mahindra up close to around 3.5%. Valuation support out there. Infosys, that was up close to around 2.5% odd. Adani Ports started moving very, very well. That was up close to around 3%. And IndusInd Bank, I remember on the day, in the last 2 months or so, there was some negative news that came in there. The stock broke 800 rupees. From there, just take a look at the returns that it's given. It's given close to around a 35-40% return just from that day. So good going on that one. Rima, what about the mid-cap space? Did a relative outperformance today though the number of stocks that were advancing were lower than the number of stocks declining.
Indeed. So the mid-cap index is up about 0.3%. The advanced decline ratio had about 3 stocks in the green for 4 in the red. So the declining stocks outpaced the number of advancing stocks. But for the week, the mid-caps outperformed. The mid-cap index is up close to about 2.2% for the week. The big winner today is Nazara Technology. Very large volumes. The stock seeing a double-digit gain. JSPL is one of the big F&O movers, stock higher by 6-7%. In the banking pack, you had RBL and PNB outside of the large cap names, which were active in trade. Mid-cap IT was also higher. First Source, L&T Technology, LTI, Persistent, Birlasoft, across the board. You had gains in the range of about 3 to 4%. And Zomato was a mover. The stock is settling above that 62-63 rupee mark. On the losing side, sugar was a bit subdued, so Sri Renuka Bajaj Hindustan came in for profit booking. The stocks were down close to about 2%. We wrap up this Friday's trade with the Nifty at that 17,830 mark, just a gain of close to about 0.2%. We're off from the session highs, but for the week, we've snapped a 2-week losing streak, and we're ending with gains for this week. With that, it's curtains down in this edition of Closing Bell. Thank you for watching. But don't go anywhere, as lots lined up on a Friday special offering Smart Money.